I want to welcome everyone from my list. Mr. Jeff Loveland from Lakefront Lending, the one, the only. There's no lake in front of him right now, but we're just gonna say it's a clever name.
That's right. That's right. Thank you very much.
Yeah. So today we're just gonna be talking about how to get under contract. Rates suck right now, right? We can agree that rates suck. And home prices are still kind of meeting rates in the middle, correct? So
Yep.
we're gonna go over this. We're gonna jump on. I'm going to lean on Jeff's expertise as if I was buying a home myself, ask quite a few questions, some of which I'm curious about too, because I'm still not clear on everything. And just maybe give some strategies for folks that would like to buy, especially right now while there's less competition and rates are up. But maybe the payments as they are right now just aren't palatable, whatever that might be. So Jeff, thank you for joining me today. I really appreciate you doing this for the people that I'm working with. And so let's talk about it. So let's talk about rate buydowns. People might have heard about them. Some people probably know about them, but let's talk about the different rate buydowns. So let's talk about just like first off, buying the rate down. How does that work for somebody?
Yeah. So buying the rate down essentially is increasing your closing costs to reduce your monthly payment by reducing the interest rate, right? So that's the overall concept. And like you said, there are multiple ways to do that. There's different options and we can go into each of those. But essentially that's what the buying the rate down, or you might even hear it called buying points, paying points. You'll hear that same terminology. And that's what people are talking about, is getting your interest rate. Let's say, for example, your given rate is a 7.5 today, and you want to buy the interest rate down to 7% or 7.25, right? So that is really the concept of buying it down. And then there's permanent and temporary rate buy downs that I can go into as well.
So yes, I'm going to get really, I am a layman, so I'm going to really get into layman's terms. I'm a caveman.
Yeah.
So, is there a max amount you can buy the rate down? Is it just a point? Is it a half point?
No. So it depends on the rate, depends on your loan amount, depends on a lot of things. But there are maximum amounts that you can buy the rate down. Typically, what we see in percentage points is roughly between 1.5% and this is speaking from a permanent rate buy down. So your rate never changes on the 30 rate fixed. It's typically about 1.5 to 2 points is the max you can do. And more importantly, is the max that you can actually pay on the points to buy it down, right? So typically, we're only allowed to charge you 3% of your total loan amount in extra closing costs to buy the rate down. If we go above that, it becomes what's called it fails a high points and fees test. So to get it, I know that's a lot into the weeds, but essentially what has happened is the governing bodies of mortgages essentially say, hey, you can't overcharge people for rates. And really the logic behind that is they don't want you as a home buyer to spend, let's say you want to buy your rate down a 1.5, right? That sounds great on the monthly payment, but let's say that's going to be 30%, or excuse me, 3% of your total loan amount, or it equates to $30,000 of extra closing costs. But it's going to take you 8 years to break even on that, with your total monthly savings breaking out to the extra closing costs. So what I look at with clients is, even if you can, maybe we shouldn't. We want to find out what your break even time is. So that's really what we focus on when it comes to buying points there.
I didn't understand that. So your break even. So
let's
really dumb it down.
Yeah, let's do some easy math, right? Let's do some really easy math. Let's say
$750,000 home. Like what the median price? What are you thinking?
Sure. Let's do $750,000 house, right? Okay. And let's say you're gonna buy the interest rate down 1%. Okay, so you go from, let's say, a 7.5% to a 6.5%. I'm just using these as round figures. And let's say that is going to cost you 2% of the total loan amount. So $750,000 loan, 2% is $15,000 is what it's going to cost you in additional closing costs, right?
But if your loan amount 750, right? So
yeah, your loan amount.
That's just saying that we're not even talking about like anything down.
Yeah.
So really, that'd be almost like a $900,000 home.
Yeah. So even if we're looking at a $700,000 loan amount, and that's what we focus on in the buy downs. Right. So If we're looking at that, you have a $15,000 additional closing cost tagged onto that because we bought the rate down, right?
And what in the normal closing cost would be what exactly, 1 to 2%?
Yeah, exactly. You're right. You're right. Probably closer to 1% is what I would say. You know,
So
uh,
seven-ish thousand dollars
yeah,
approximately. Don't
seven
quote
to
us.
eight,
We're just playing with
somewhere in
numbers.
that round. Yeah, yeah, exactly. And so with that, you have your, let's call it $7,000 of standard closing cost, right?
Right.
Plus your $15,000 of buy down. So we're at 22 grand of just closing costs, right? But we bought your rate down 1 full%. Now, where we get into the break even, the fun part here, let's say that 1% saves you roughly $200 a month. And it might be a little bit more than that, but I'm just gonna use that for round numbers. So you were confused about the break even piece. Here's what your break even point is when you're paying points. You take what the extra cost was. So in our scenario, $15,000 divided by your monthly savings on the rate, which was $200, right? So you'd have to be in that loan, in that scenario, for 75 months. Or if we divide that by 12.
Okay, I got it. To break even.
So six years and 3 months or to just break even, right? So in that scenario, it might not make sense because statistically, you're going to sell, refinance, or pay your house off every 5 to 7 years, right? So what we look at from a financial standpoint is, hey, are you really wanting to invest 15 grand to buy your rate down? Maybe you are, maybe you're okay with that, but it's going to take you 6.25 years to break even. What happens when rates come down to 4.5% 3 years from now and you want to refinance?
Right? So how does that work, right? Are there any penalties to that? Are they locked?
There's no penalties, but you've put $15,000 on the line up front, right? And it took you 6.5 years or 6.25 years to break even. You're only halfway through that. So you've kind of painted yourself in a box where you're leaving $7,500 of your 15,000 kind of out there and you've wasted that money. So that's why sometimes we want to look at the full financial picture and say, does paying all those points make sense for you?
But would the caveat be that if you got like such a killer interest rate though when you refinance,
who
really
cares,
matter.
right? Yeah,
Right,
exactly.
okay.
And that is the caveat with that. There's another caveat, and I don't know if you want to talk about this later.
Let's do it.
If we're talking about 15,000, right? A lot of extra closing costs, right? The part where it makes a lot of sense, especially in this market, and I'll let you talk about that because you're the agent and you know, but what about if I have a seller willing to pay all of those closing costs for me, right? If a seller's willing to give me 22 grand, yeah, take it. It's free money, right? At that point.
And that's part of the reason why I wanted to talk about this, because there's a lot of homes in the market where either the seller got bad info from the agent or the seller is hanging on to their neighbor's house that sold a year ago when rates were totally different and they want to get that price. I just talked to somebody about this and it's just not that market right now. Maybe in the spring, but right now it's not that market and homes are sitting longer and maybe they're not priced to sell right away. Cause I think what the stat was like 60% of the homes went under contract just last week had a price reduction. And that price reduction was like 6 to 7%, right? 6 to 7, not 67.
I was gonna say 67. That's steep.
Yeah, 6 to 7% approximately on average, right? So what I try to coach my buyers on is, okay, you're not going to be able to time the market perfectly. The people who are selling right now also have to sell, right? Or they need to sell. So they're in a different position than they were just a year or two ago, right? Where they had multiple options. So if there's a home that comes on the market that checks your boxes, especially if it's maybe overpriced, and it sits and doesn't sell in that first few weeks. I think the median amount of days is like 28 last time I checked. Let's say that first month, right? It's been on the market for a while. So you got a couple options. If you love that house, you need to buy a house and you can do something like get your mortgage rate down to where now the payment makes sense. Okay. And you've done your math and now you can feel comfortable living in that house. And yeah, let's go into the deal asking for a seller concession up front, asking for whatever it takes after consulting with a lender like yourself. You know, how much do we need? Do we need 22,000? I mean, if we go up higher, is there a cap on that number? or is it
Depend.
a sliding scale?
No, it's a sliding scale. It depends on your loan type, number one. So whether you're conventional, if you're doing an FHA, a VA, jumbo, that kind of thing. It
Right.
also depends on your down payment. So the sliding scale goes from anywhere from 3% of the total purchase price is what you can get in seller paid closing costs, up all the way up to 9% if you're putting enough down payment down, right? So that changes and that varies there.
So if
But
they put more down, they probably have more leeway. Is that
yeah,
correct?
exactly. That's 100% right. Yep, that's 100% right. So the more you put down on a standard conventional loan, you go from 3%, 6% to 9% in increments of down payment. So
Is it just 3% from the buyer plus whatever from the seller, or is it 3%
no,
total seller concession
3%.
and buyer?
So what's called interested party contributions. So the seller, the max that they can do concessions is 3% if you're putting under 10% down. 10 to 25, 24.99 is 6% of the concessions. And then above 25% down, you're at 9% concessions, right? But
Right.
to your point, I think it's actually really, I'm glad you brought that up, because you said what, 60 some odd percent of houses that went under contract last week had
Price
reductions
reduction. The
of
median
six
number,
to
yeah,
seven,
it's
6 to 7%.
of them. Yeah, exactly. Yeah.
And I looked at like a $750,000 house, right? At a 7% is what, 52 grand?
Yeah.
I mean, that 6 to 7 doesn't sound that much, but if you start looking at the actual numbers, that's substantial, right? That's double what we were just talking about on putting concessions down. So it's
Yeah.
huge.
Yeah. So if you're going into that, and I know sometimes folks want everything to be perfect before they make an offer. And like I tell people, especially on the buy side, we're shooters shoot, right? We're going out there, we're taking chances. Sometimes I got folks that are just too far off,
Sure.
several $100,000 off, right? And then we have to be realistic to a point. We have to look at everything, and we have to look at the comps for that particular home. Because if the comps aren't making sense, I understand wanting to get a deal, but some stuff is just not realistic. So, looking at the comps in the neighborhood, looking at in the last few months, even, right? What price might be the price? Can we get a lower price before they do a price reduction? And now more buyers are interested because now everything's perfect for them. And now you're in a bidding war, which has happened to a few homes recently that I've been looking at, or do you just beat them to the punch while they're not getting the showings, right? And that things are kind of slow, get in with a price reduction and maybe even a seller concession. And now that payment's much easier and more palatable for someone, as opposed to trying to wait till everything's perfect. Because when you do that, everybody else is going to jump in, and then we're going to be back in that cluster F from 2021 where there's like 15 people bidding on the house, and now you're 50 grand over, right? So it's kind of a wash the other way. Which I don't think that's going to happen. I think, I've seen pretty good arguments for the Fed to keep interest rates up. Is to correct the home market a bit so it's more affordable. Because if we do another price reduction or another rate reduction substantially, I think there's just so much pent-up buyer demand, it's going to cause a frenzy again, and then home prices are going to go up again. It's going to become too unaffordable. But who knows? Don't take my advice for it. Okay, I'm not Michael Burry and these people. I'm just talking just as someone watching the market. So that's the permanent rate buy down. Now that could be a good option, right? Because I've seen the Mortgage Bankers Association say that rates might come down to in the 5s in 2025, right? I've seen that. So that might be a good option for you. Are there any penalties to refinancing within a year or anything like that? Is there any extra charges, things to be aware of?
Nope. There's really not. There's no penalty to you. There's no early payoff. I take that back. There are some loans out there. The loans that I originate, I can speak on what I do, right? That's all I can talk about. But we have no early payoff. So there's no penalties for you. We ask that you wait 6 months because you won't get penalized, but I, as a loan officer, will. That's really the only gentleman's agreement I ask for at the end of every closing. Just wait 6 months. If you go up to Blackhawk and you hit it big, just pay everything except for the last couple months payments off, right?
Are you saying that I can go to Blackhawk and hit it big?
Because I'm saying that there's an opportunity there. I wouldn't bet on it, but
I love my parlays. I love my football parlays, but I'm terrible. Next thing. So let's talk about the other thing that's pretty popular. 3-2-1, 2-1 buy
One
downs.
out. Yep.
1-0,
Yep.
yeah, 1-0 buy downs.
Yep.
Let's chat about those really quick.
So those are what are called temporary buy downs, right? So we just talked about permanent buy downs where they're permanent, if we went from the 7.5 to 6.5, 30 years, right? 20 years, 15 years, whatever the term of the loan, that's it entirely until you pay it off or refinance it. Temporary buy downs are just that. They're for a short period of time. You hinted at it. There's a 3-2-1, 2-1, 1-0. So what those are rate buy downs that last 3 years, 2 years, 1 year, right? And they're a percentage less than what your rate is. So let's say, for example, your given rate today is 7.5%, right?
Right.
And let's use 2-1 buy down because that's the most popular.
It is the most popular, yeah.
So 2-1 buy down is a 2-year buy down. What you get is your given rate is 7.5%, but year one, you're at 5.5%, right?
2% less.
2% less. That's 2-1, right? We'll get to the one here in a second. Year two, you're at 1%. So you're at 6.5. So you're at a 7.5% interest rate. Year one, you're at 5.5. Year two, you're at 6.5. And then it reverts back to the 7.5 that you were originally at. Also, no penalties for refinancing if you see rates come down during that time. So there is no penalty there. The caveat with those, they usually have to be paid for by the seller. So concessions are usually needed in that instance. Same for the 3-2-1, same idea. You'd be at 7.5, then you start at 4.5, 5.5, 6.5 for those 3 years, and then you revert to 7.5. 2-1 is the most popular, I would say, because number one, it gets you 2% lower on an interest rate. If you can get a 5.5 interest rate right now, that is smoking. That's amazing. But also it's the most obtainable for getting the concessions by the seller. Typically what we're looking at is you would need 2% in concessions to buy the rate down that 2%. So let's say on a 7.5 or $750,000 purchase price, we'll go back to the purchase price there. If we got 15,000 or 2%, that would roughly cover our 2-1 buy down for that cost. If that makes sense.
Yeah, and that's based off the purchase price.
Correct. Yeah, that percentage is based off that.
So if you have like 20% down, you've got like $500,000 some dollar loan, doesn't matter. It's based off the purchase price. That's good to know. That's good to know. And then so 3-2-1 is what, a 3% off of that?
Correct. Yeah. Yeah.
So now you're talking
4.5% starting.
Hey, right? If people are overpriced enough, it's possible.
Yep.
That's
100% right.
Like I tell people, now's the time to take chances and be fine with it if you don't get what you want, if the numbers don't make sense. So that's great. So, you can do 2-1, and then hopefully you're optimistic, right? That, the buyer, you want to be optimistic that hopefully rates come down. I would just tell people as a word of caution, make sure that whatever the rate's at, whether it be 7.5 or whatever we're using for examples, make sure you can afford that payment, right? Don't gamble and get yourself in a situation where in 2 years, if rates don't come down or you're in a tough position, now you're stuck with a hefty payment. That's not what we're coaching you to do. This is
100%, 100%. And in fact, lenders have already thought that through for us, as far as like the banks that lends the money. We have to qualify you at that higher rate to make sure on paper you can qualify for that. But to your point, Eddie, 100%, you need to be aware of your payment increases and budget your life accordingly, right? In fact, when you sign your closing disclosures and you sign your papers, you will see, hey, my payment is X year one. My payment is X plus $350 year two. My payment is X plus $700 year three, right? So you truly do see that incremental step up, but you do need to plan accordingly with that type of loan.
Okay, good deal. I think for as far as rate buy downs, that pretty much covers the rate buy downs, correct? There's
correct.
No other
there's
out there
there's
right
a
now.
1-0. We didn't go over 1-0, but you can
Same
understand
thing, but it's 1% less.
1% yes for 1 year. Yeah,
for 1 year,
correct.
right? And a 3 would be 3%, then 2%, then 1%, then back.
So that's a 3 year.
Right. There's no no penalty. We've talked about that. As far as, let's talk about the folks, because this is like the most common thing. I've got people who have homes they bought, they have a killer interest rate, and I tell them to rent if they can do it, but a lot of them have their equity tied up.
Yep.
Because if you can rent it and cash flow, just keep the asset, right?
Yep.
But a lot of people have their equity tied up in their homes. And what about folks that want to buy because they have to, right? Maybe the home is too small, their family's grown, they need to move closer to work, whatever that might be, right?
Yeah.
And they want to buy something, but they haven't sold their house just yet.
Yep.
So they need to tap into that equity. What are some options they have?
So there's
any creative thing they can do to help with that situation?
For sure. So there's a couple different options, right? And it all starts with sitting down with a loan officer and exploring your financial scenario, right? Because, and I'll use this as an example. I had a client, very similar situation. They wanted to sell their house, all their equity was tied up in the house, right? But they had a big glaring problem, was a lot of debt, and consumer debt is the highest it's been ever. If you look at credit card debt right now, car loans, like that nature. So what we did is we strategized and used a home equity line of credit. They weren't in a bind for time, but they had equity, but they had debt, which was impacting their credit scores and their qualifying ability. So what we did is they took a HELOC, they paid off all their credit cards and car loans. It jumped their credit score substantially. We qualified them for the new house. The HELOC, which is a home equity line of credit, is what that is. It's basically, think of it like a second mortgage or just a line of credit on to be able to tap into your equity. They were able to tap into that, pay off their credit cards, pay off their debts, build their credit score. They sold the house. When they sold the house, they paid that original HELOC off, that line of credit off, and then put everything else into their new home. So that right there was a really unique strategy, because we were able to not only get them into a dream home, but we were able to take advantage of their equity and pay off their debt and build their credit. Whereas if you were just selling and buying, you have to go off of whatever credit score you're at that given time. So that's one really cool strategy there. The other one that we're seeing is a bridge loan. And you may have heard of it, but essentially it's a loan that allows you to tap into your equity and it rolls your equity that you have on your current home, and then you can buy the new house with that loan as well. It basically covers your original mortgage, takes the equity and rolls it into the next place.
What does that look like from like a closing or like a fee standpoint to the buyer?
Yeah,
right.
it's
So
typically
if they're home equity line of credit, what are they going to pay that's different than a normal loan? How much extra?
Yeah, so those interest rates are a little bit higher, so that's why I like them for short term. HELOCs right now are in the high 9s, low 10s, depending on your credit situation, right? Depending on how much equity you have in the house. And we offer HELOCs, but so do credit unions. I mean, you can get HELOCs all over. As far as what those costs look like to you, it's essentially the interest payments that you've accumulated during that stint of taking out the HELOC to paying it off, right? Just like a credit card thing. Gotcha. So that's essentially what it looks like. Depending on what bank you go to, what credit union, what lender, whatever, some have closing costs, some have them rolled in. The ones that usually don't have closing costs typically have a caveat that you have to be aware of, that you have to have that line open for 2 years. So you do have to be cautious about that. If your game plan is to, hey, I'm going to have it for 6 months and sell my house and do all that stuff, you may need to look at a different HELOC option, because sometimes with the no fees, what they're doing is, hey, we're going to collect interest on this for the next 2 years. So we're going to waive all your fees up front. And so it won't mesh with that strategy we just talked about. So you do have to be aware of that. And that's why it's very important to have that strategy conversation with your loan officer, with your agent. Hey, this is what my game plan is going to be. I'm going to tap into my equity, pay off my debts, build my credit, and move in 6 months, 9 months, 3 months, whatever you want it to be.
Yeah.
And you just want to make sure that you're not getting into a home equity line of credit that is going to impede that.
Okay. What about the bridge loan?
So bridge loans, the big thing with bridge loans, you typically see higher interest rates on those than your standard conventional loans, right? So once again, let's go back to the 7.5% interest rate on a conventional loan. You might be looking closer to like 8.5% on the bridge loans. is what, once again, depends on your credit, depends on the equity stake. So that can vary, but by and far it's typically higher on the interest rates, and that's where they're making their money on that back end. The banks are making the money on those.
And these are things you probably don't want to do for more than a few months, 6 months, a year.
Correct. Well, and it depends on, so the bridge loan would buy that full new house. So what I typically see people do is they buy with the bridge loan, and then usually those will have 6 months, 180 days where you can't refinance them, and then they refinance into a traditional conventional mortgage or whatever.
Gotcha. So you would take that equity and that loan and you would use that to purchase the house.
Correct.
And then that would, you just would be at a higher rate for whatever their stipulations are.
Yeah, correct. Exactly.
Until you get refinanced. Okay.
Mhm.
Interesting. So that makes sense. Hey, but compared to what people were doing in 2021 when they were paying like $300,000 over ask or $50,000, I mean, might even be cheaper,
Yeah. Well,
so
and you're right. Every market has different opportunities and different hurdles, right? Like you said, 2021, sure, we had great interest rates, but you were overpaying on houses 50, 100, 150,000 easily, right? I saw all the time, you saw it all the time. Now you're getting concessions, you're getting, you're underpaying on houses even potentially, but you're gonna come with a higher interest rate. So there's give and take on both that.
Yeah, just from the real estate side, you also have contingencies again. So you get your inspection. Now if you get a huge price reduction and you get concessions, any good agent's going to say, okay, well, then you just get an inspection. We're not going to fix anything. You're taking it as is, right?
Yeah.
That's what they should do, but they don't always do that. You have options now. You're negotiating. You've got a better position to negotiate from than you had before. So that is the benefit of buying right now.
Yeah.
That being said, if your numbers don't make sense, nobody's telling you to buy. Take your time, stack your money, get your credit right, do what you got to do. The other thing is like, if it doesn't appraise, right? Your appraisal contingencies, your loan contingency, you got a lot of options now that you didn't have before. So there's opportunities for further negotiation potentially as well too.
Yep.
Cool.
So one other thing, if we can stay on that topic of buying and selling, one thing that I've seen pretty popular, I had mentioned that consumer debt is super high right now, right?
Yeah, let's talk about this because that was a good idea that you had.
So one thing that I want to talk about is, and what I'm seeing with clients right now, is not just refinancing and paying off debts. It's taking a full look at your financial scenario and saying, hey, what works best for you? So right now, what we don't have in this market is good interest rates. You hinted at it, obviously that's the case. But what we do have a lot of, by and far, and not everyone has this, but most of people have equity in their home, right? They have equity if they're looking to sell and buy. Now, what a lot of people look at it and said, hey, I'm at a 3% interest rate. I'm a 3.25% interest rate. I'm a 2.5% interest rate right now. Why the heck would I move? But what they don't look at is what their total monthly obligations are. Average car loans right now come with an $800 payment. In fact, 30% of new cars that are leased or sold or put under some sort of financing are over $1,000 a month, right? Credit cards, average good credit, well-qualified buyers, new credit cards, 24%, right, is what we're seeing on interest rates for them. Now, what we look at is, okay, Mr. Home Seller, potentially you have $300,000 in home equity here, right? And you were thinking, I'm just going to put all this $300,000 on my next house and drop that monthly payment. But you actually have $90,000 in consumer debt between credit cards, car loans, student loans, all those things, right? What if we paid all those things off? You put 200,000 down, or let's say 220 down, because we have 300,000, we paid 80,000 off. Put 220 down on the next place. And sure, your monthly payment is higher than your last mortgage. And sure, your interest rate is higher than your last mortgage. I get all that. But we just paid off all your debt. Your total outgoing bills are $600 cheaper. Is that something you'd want to look at? And a lot of people don't think about it from that standpoint, where they have all this consumer debt but they have all this equity and they still want to get into their dream home, right? Like you said, families change. They get smaller, unfortunately, sometimes they get bigger. And
Yeah.
you need to move, kids are getting into school, you need to put them in the right school zone, whatever it is, you need to move, you want to move. What if we can sell your house, get you in your dream house, and eliminate all your debt at the same time? Would that be something you'd look at? So that's one of the conversations I'm having with clients right now, because they really don't think about it. They're just they're focused on the mortgage and not, wow, this money building asset that I have, which is your home, can help relieve you from all this consumer debt that you've accumulated over the last several years.
Yeah. What's the big picture, right?
Yeah.
What's the overall amount going out, coming in, going out every month?
Right.
I have so many people who also, with buying right now, because inventory is low. It's not bad right now. It's 2.5 months, which is the best we've had in a long time. But with a lot of folks, they're not, they've got a house, they're comfortable, they'd like to get another house, but they're not quite ready to go if that house comes on the market. Right. And there's still, like I tell people, this isn't going to happen for every house, right? There's still homes that if they check a lot of people's boxes, boom, somebody pops out of nowhere with a cash offer and it's off the market. Might not be as competitive, but there's still homes that will sell the first weekend. And when homes price reduced, there are still maybe 3 offers, right? It's not nearly as much over, but it strikes a chord and people jump on it. So for folks that are looking, they don't want to sell their house and rent somewhere, then maybe that might be a good option for them, right? How quickly does that process, take place if they do see a home? Can it happen over the weekend? Can they get a HELOC or
pre-approval or a HELOC?
Yeah.
So HELOCs are typically about 3 weeks, I would say. You need to plan accordingly. Yeah. If you're planning on, hey, just want to put an offer, I mean, we can pre-approve a client in a day, less than a day, right? Mm-hmm. But what I would suggest is if you just think it's on your radar, get pre-approved. There's no cost to you, right? We can go through it. We can even do a soft pull on your credit, so we're not impacting your credit negatively, but it still gives us a very good look at your credit score, gives us a good look at all your debts, gives us a look at all of your information as far as how much you make and how much you want to buy and what you're qualified for. So what I recommend to clients is if you're even thinking about it, get pre-approved, have the conversation. Just like anything else, the more you know, the more you can do. Right. And so if we're looking at any of those scenarios of the HELOC, the bridge loan, the paying off debts, what have you, it's smart to have that up front, because yes, I can pre-approve a client in 2 hours, an hour, right? It depends on how quick the client is. If they can get me all their stuff, I can do it really, really quick. It can be over the weekend too. That's not a big deal. But if we're trying to if we're trying to complete your financial scenario and we're trying to look at, hey, what works best for you, just like anything else, would you rather rush into it, or would you rather take the time to make sure this is the best strategy for you? So that's why I tell people, like, listen, there's very little upfront cost. I mean, the upfront cost for you is time, right? Do you have 30 minutes? Do you have an hour that you can allocate to complete a loan application, hop on a phone call with me and discuss your goal?
So even if their equity is tied up in their house, you're saying you can still kind of do like a rough algorithmic assessment of
100%. Yeah. I mean, working with an agent like yourself that knows the market, I can easily reach out. Hey, here's what our strategy is. We're trying to roll the equity in the next place. We want to pay off some debts. Can you please help me out, figure out what the value they're looking at, what we think they could sell for, and what do you think they could walk with? And that's the big number. So that's the thing. I think working with a team that allows you to figure out how much equity you have and how much you can utilize on the next place is going to put you as a home buyer in that much better situation.
Now, if I'm writing that offer, the other thing I want to ask you, we'll talk about jumbo next, because Rate Buydowns a jumbo and strategies going over the median home price.
Right.
But just to stay on this topic for a second, because I'd imagine if someone is doing HELOC, it probably takes 3 weeks, because I'd imagine they have to get an appraisal or some sort of assessment done.
Correct. They got to you're exactly right. Yep. And they have to still do a credit approval and all that kind of stuff.
So could they do that ahead of time and then hold off on activating that? Is there like a time frame, like 30, 45 days until they have to activate that HELOC to where they start paying interest?
No, but what they could do is they could pull the HELOC. So to answer your original question, most banks are going to want to close it quickly, right? Because just like any other rate, it's locked for a finite number of days. So they want to get that closed, right, before the rates go up or what have you. But what you can do, and this is one thing that I've done personally, is you can pull that HELOC now, right? Even if it's 6 months from now that you want to do this strategy, you pull the HELOC, don't put anything on it. Just like a credit card, right? A credit card with $0 on it doesn't accumulate any interest.
Gotcha.
But the nice part about that is, let's say you do find the house, you have the HELOC, it's in place, you've already had the conversation with a lender of, hey, this is what I want to get pre-approved for. It takes you however long it takes you to log into your bank and transfer those funds from the HELOC, less than a day, right? To transfer the funds.
Because that's, you know, because even in this market, getting a contingent offer accepted is still tough. It's still like, if you're trying to time up selling the house, most sellers or listing agents do not want to have that home tied up contingent on a deal they're not a part of, right? To where that might fall through, and now they've been off the market for 3 weeks, 4 weeks, whatever that might be.
Right.
And I know some folks would like to do contingent because that's what feels the most comfortable, feels the most safe. It's just not super practical yet. Sometimes you can do it. It's just not as enticing to sellers and listing agents. Jumbo. So let's talk about jumbo, because I know there's certain restrictions with rate buy downs with jumbo, correct?
Yep. There are.
Because you know what's crazy though is like we listen to all these stats and market stats, and I think like above, don't quote me, I think it was like above 3 million. Like there was the other way. The average home was selling for 500K more or something crazy. It was like this weird flip of dynamic, right?
Yeah. That doesn't surprise me at all.
It's a good problem to have. I hope
Yes.
they have that problem. But so jumbo limits right now are what in Denver?
So they just increased them. So Denver's an interesting spot. It's pretty populated, if you didn't know, right? So loan limits just increased to 750,000.
Okay.
That's
what we've been talking about.
Conforming loan limits, right? So if you're under that, you can do a conventional loan. That's totally standard. If you're above that, there's a little window, about a $36,000 window from 750 to like 786. That is what's called a high balance. It still falls under conforming underwriting guidelines, but it typically has a little bit higher interest rate in that little window there. Now, anything above that 786 is going to be a jumbo loan, right? And that's going to be a true jumbo. The big difference between conventional loans and jumbo loans for anyone as a home buyer is going to be a few things. The underwriting is going to be a little stickier, right? They're going to be a little bit more fickle about what they're asking for. If you have something that's a little bit more of a concern, they might ask a little deeper dive on that one. And understandably so, you're asking for quite a bit of money to borrow, right? So they want to make sure that you're a well-qualified buyer. The other thing is you're going to see lower debt to income ratio thresholds. So they don't want someone maxing out their income or their debts rather, by utilizing a very, very high debt to income ratio on a jumbo loan. And then the last thing that we see on those, that's the biggest concern is from a home buyer standpoint, is the addition of what are called reserves. So let's say, for example, you're buying a house and your down payment, your closing cost, everything all in is going to be $150,000, right? So you're planning on wiring over $150,000. Now with jumbo loans, they may make sure that you have 6 to 12 months of reserves, so money that's not included in that $150,000. Maybe they want to make sure that you have, $40,000 extra in a retirement fund, in a savings account somewhere, in case you lose your job, in case you can't make the mortgage payments. You have a reserve that you can pull from to make sure the mortgage is getting paid. Those are really the big three differences we see with jumbo loans. There's other ones, but those are the big three.
And then what about, can you do a rate buy down with a jumbo loan?
So a lot of investors are just coming. Yeah. So yes and no, right? So depends on the investors that are out there, depends on banks you're talking to. But the biggest thing is, yes, you can almost always do a permanent rate buy down. So like we were talking about, from going from a 7.5 to a 6.5 or 7.5 to a 7 or what have you, just a permanent, it's going to be there forever. Yes. But temporary buy downs, more and more investors are coming out with or excuse me, temporary buy downs, more and more investors are coming out with where you can do the 1-0 buy downs, the 2-1 buy downs. You are seeing more and more of those investors, but they are still pretty limited compared to what the conventional offerings are.
Gotcha. But you can still use seller concessions towards those. It just might be
100%.
and that's on a
100%.
case by case basis. That's something that they probably need to talk with a lender like yourself about, right?
Correct. Yep. Exactly right. So that's the biggest thing there. You know, with the jumbos, you can do the permanent, you can do the temporary. You know, one of my investors that I send a lot of my loans to, we can do jumbo, temp buy downs, 3-2-1, 2-1, 1-0, but they have to be kind of what we consider A paper, higher credit, higher down payments, those kinds of things, right? They want a less risky buyer. And if you think about it from the standpoint of like, okay, if it's a less risky buyer, they're probably going to be, just like we talked about earlier, knowing that their payment is going to increase substantially when their rate increases, you know, 1% year over year for the next 2 years or what have you.
Gotcha. And then what about, before we go, for FHA and VA? It's been so competitive, it's been tough to get those accepted, but I think those are coming back around now, which is nice.
Yep.
What about for FHA and VA loans? How does that work?
Yeah.
Can you do rate buy downs with those?
Yep, 100%. 100%. You can do permanent rate. You can do permanent rate buy downs. You can do temporary rate buy downs. Your seller concessions. The nice thing with FHA is you can actually do up to 6% in concessions off the purchase price, right? So if you're FHA is a little bit lower on the purchase price usually, right? But let's take, for example, a $400,000 house. We have a $400,000 house and we're able to use let's say 6% concessions. I don't want to do the math incorrectly on the call here. $24,000, right? We can't. Now, ultimately, that's up to the seller if they're willing to give that. But by by the rule book, we can ask for that amount, and that can be utilized towards your closing costs, towards rate buy down, permanent and temporary. So it's something that is really unique with FHA. Now, VA is very, very similar, but they have a cap at 4% of the concessions.
Gotcha. Okay. So there's options, which is great.
Yep.
Cool.
Absolutely.
Hey, Jeff, that was super helpful. Is there anything else that I'm missing? I wanted to ask that as if I was the first time we ever talked, and hopefully I sounded totally
I think you did great.
I learned some stuff though. I learned some good stuff today.
I think the biggest thing for anyone, even if, and I'll be transparent, even if there are people that aren't working with me, you know, I talk with friends and family that live in other states that I'm not licensed in, that I can't do loans in. I tell them the first thing, hey, have you spoke with your agent and have you spoke with your lender, right? Even once again, people have this concept of, hey, I'm not buying in the next 30 days. I don't need to talk to a loan officer. False. Get that out of your head.
Yeah.
I have clients that are 18 months removed from buying a house, right? You know, let's say they have a bankruptcy and it doesn't fall off until that time. You know, we'll set up everything else. Hey, here's what we're going to save up. Hey, here's what we're going to do. Work on your credit. Here's what we're going to do to strategically look at paying off your debts with the equity of your home. Make a plan. I think where people get in a really bad spot, especially when it comes to real estate, is they have not set up their team, meaning their lender and their real estate agent, and kind of conveyed what their goals and expectations are. As a home buyer, the more you can communicate with someone like Eddie and someone like myself, the less stress you're going to have in a real estate transaction, and the more happy you're going to be with the end result. 100%.
It's just like investing in real estate. Like I tell people that are my investors, if it doesn't pencil, it doesn't pencil.
Right.
We move on. You make your offer. If we make an offer, it's low, they don't accept it. Or let's say they send out a mass email, which the agent should do, to their list to try to get other offers. Hey, on to the next. You know, we're not going to get stuck in a position where you're in a house and now your payment's too expensive, you're unhappy, and then you want to get rid of the house in a year, right? It's kind of the opposite right now. There's a lot of people who got a killer payment that might not be totally in love with their house, right? Because they bought it was so stressful. Anyways, well, hey, Jeff, thank you so much. I appreciate it.
Hey, thank you.
If anybody has any questions, how can they get a hold of you, Jeff?
They can give me a call. You can email me. I think we're going to have my contact information at the end of this video. Is that right? So call me, text me, any of those things, email me. I'm happy to answer any questions. And because you guys all work with the amazing Eddie Johnson. One thing
Oh,
I'll
thank you very
offer
much.
is I have an amazing tool that Eddie has access to that helps you get an instant valuation of your home if you are a homeowner.
Oh, yeah,
You
that's
can
all I
reach
know.
out to Eddie and we'll get you that over and get a full report on not only how much the house is worth, it gives you the comps in the area, but also gives you how much, if you're thinking about it, how much you could rent your house out for. If you do have that killer payment, like Eddie just said, it will show you a good idea based on other rentals in the area, how much you could rent that house out for. So if you're looking to start your little real estate empire, it's a great tool to take that first step.
All right, everybody. Have a great day. Thanks, Jeff. Appreciate
Thank
it.
you. See ya. Bye.
Bye.